Hey guys, John Bubello here. Today we're going to talk about annuities. So before we jump in, let's get started and define what an annuity is. Well, the first thing an annuity can be is it's a payment definition. It's a series of guaranteed payments. A pension is your perfect example of an annuity. But an annuity can also be a product. It's a product created by insurance companies and sold by insurance companies. And so there's really two types of products sold by an insurance company: a fixed annuity and a variable annuity. Now, a fixed annuity pays you a fixed amount of interest. It's like a CD that you buy at your bank. With the bank, you lend money to the bank, they pay you interest. With a fixed annuity, you lend money to the insurance company, they pay you interest. Now, the variable annuity is what I want to talk about today. And a variable annuity means that you're going to own investments in the stock and bond markets, and the value of the annuity is going to fluctuate with the market. And the neat thing about a variable annuity is you can get an option on it. You can get a guaranteed stream of retirement income. So here's the good. A guaranteed income annuity gives you a guaranteed income stream. And this is helpful if you're risk averse. And it's also helpful because the income stream is guaranteed to continue even if the internal investments in the annuity do poorly. But of course, there are downsides with variable annuities. The guaranteed income stream may not increase with inflation, so your buying power is going to decrease over time. You also have limited investment flexibility. The insurance companies limit what you can own inside these annuities. And finally, they're complex. Most people don't even understand what they own shortly after they buy them. Now, the worst part about a variable annuity is the high fee that comes with it. The fees are needed to provide the guarantees, essentially buy insurance, and frankly, to pay salespeople that sell them. And those fees eat into the returns, and they destroy performance over time. And ultimately, because of the high fees, you reduce the amount of money that will be guaranteed. So you get a guarantee, but you get high fees, and then you end up getting guaranteed less money because of the high fees. So here's some of the fees that are baked into an annuity, and they can add up to 3.25% to over 4%. And when you build a portfolio in an annuity, your expected rate of return is probably only 6.5 to 8.5% per year. And then you take out the fees and it just decimates your returns. Now, the biggest problem with annuities is that the purchasers aren't offered good advice from the salesperson. And later they figure out, when they create a real plan for their retirement, they figure out that the annuity doesn't fit into their plans. And they liquidate them without ever using the guarantee, having paid those high fees for a very long period of time. Now, if you do own a variable annuity and you're questioning whether you should still own it, my recommendation is that you contact a certified financial planner, and they can help you figure out whether it makes sense for you to continue to own that annuity or whether it's time to liquidate it and move on.